Hey everyone, let's talk about some big news that could change the way you save for retirement. You might have heard that there's a new White House order out there that's paving the way for 401k plans to include what are called alternative investments. These are things like cryptocurrency, private equity, and privately owned companies. On the surface, this sounds exciting. The idea is that these kind of investments, which have traditionally only been reserved for very wealthy people and big institutions, might offer the potential for higher returns and better diversification. The argument is that giving everyone access to these options could help your retirement savings grow faster. But we want to make sure to look at this with a clear, informed, and balanced perspective. While there is a potential for higher returns, the new policy can add new layers of risk and complexity to retirement savings. Here's the breakdown of what to be mindful of. Unlike stocks and bonds that are traded on public exchanges every day, alternative investments are often much riskier. Their value can be extremely volatile and they aren't easily converted into cash. This illiquidity is a big deal. If you need to access your money for a loan or a hardship withdrawal, it might not be as simple as selling a stock. These investments often lack the same level of public disclosure and transparency as traditional investments. It can be much harder to understand what you're actually investing in, how it's valued, and how it's performing. This means you have to be extra diligent and really understand what you're getting into. It's important to know that alternative investments typically come with higher fees than the lower cost index funds and ETFs that many of us rely on for our retirement savings. These higher fees can eat into your returns over time, so you need to weigh the potential for higher growth against the higher costs. The good news is that these new options won't likely be automatically added to your portfolio. It will be up to your employer's plan to decide if they want to offer them, and then it's up to you to decide whether to invest. This puts the responsibility squarely on our shoulders to educate ourselves. So what do we do about this? While it's great to have more options, remember that your retirement is a long-term journey. The most important thing you can do is to stay knowledgeable and positive and make choices that align with your personal risk tolerance. Don't feel pressured to jump into these new investments just because they're available. Focus on the fundamentals, contributing consistently, having a diversified portfolio, playing the long game, and making sure you understand the investments you own. And always read the fine print. Thanks for watching.